Just wanted to comment on Baby Bunting result out on Friday, obviously. So it did miss our forecast. We were top of the street, so roughly in line with consensus for two key reasons there. Firstly, like-for-like sales fell short. Predominantly in December, it implied they had a negative like-for-like sales growth in that month, and we're not used to seeing a bit of volatility in Baby Bunting's comp. So when quizzing them quite heavily on that, all they could call out was that weak consumer sentiment in that month, potentially a little bit of the smoke impact from the bushfires with pregnant women reluctant to get out there a little bit, I suppose, but still doesn't quite fit right. But it was negative comps across every store in every state, so that tells us probably it was just a bit of underlying market weakness. That has bounced back really strongly into the first 7 weeks, with their comps up nearly 6%. If you exclude the cannibalisation, they're seeing in some stores up over 7% in the first 7 weeks, so a nice strong pullback. Gross margin really strong, nicely ahead of everyone's forecasts, and that's that beautiful private label exclusive product expansion that they were seeing there. But the other key result driver was just around the OPEX, the operating cost base. So it's roughly in line with what we're forecasting for the full year, but it has been more front-loaded into the first half. And actually, if you look back at last year, it's exactly how it played back there too. So on first inspection of the result, the stock got sold off around 12%, with the market thinking, this is going to be really hard to get to guidance in the second half. But if you look at how they played out in the second half of last year, it looks pretty well on track, to be honest. So the comps, really strong with that trading update, obviously, and the gross margin continues to expand. The OPEX, they've clearly said, will roll off in the second half. So if you map through those key line items together, we get to around $36 million of EBITDA, which is roughly the mid to top end of their guidance range. And looking at consensus today, it looks like everyone's kind of thinking the same way. So setting the miss aside, I suppose, really nothing to shift our view here. This is our all-rounder pick in that it has store rollout, it has immense gross margin upside, which we haven't really factored in yet. And of course, because it's young, it's investing as a 56 store retailer, it's investing as if it were an 80 to 100 store retailer. That's the right thing to do now, and will give us operating cost leverage down the track. So we've kept the buy there, really haven't changed our forecast, tipped the price target over to $4, and very comfortable with this investment case.